With all the knowledge that I've accumulated over the past 8 years, if I had to go back to when I first began trading, these are going to be 7 important lessons that I would tell myself if it was back in 2016 before I placed my first trade. If you keep an open mind and you listen to this advice and you implement at least one of these concepts that I'm gonna go over, I'm very confident you'll see a big difference in your trading. One of the worst things a trader can do, especially one without a proper strategy, is trade with way too much position size. It doesn't matter if you have $100,000 or $2,000, right? You should not be trading with your full account size. I recommend every single trader, especially ones who are trying to build a strategy or develop an edge, to simply size down. That way, less emotions are influencing their decisions. What I recommend every beginner trader to do, regardless of your account size, is a 3-step process which will help enable you to build a repeatable, consistent trading strategy. The first step to this equation is trading with 1 to 3 option contracts or 1 to 3 micro future contracts once you understand the risks of margin trading. Now in this period, we're gonna have 1 to 3 months where we're really focusing on consistency and not so much the dollar amounts. In this period, our main objective is to have losses which are at least 2 times smaller than our wins. I don't care if the average win is $10. Our average loss has to be $5 or less. And if our average win is $100, it's a little bit of a higher average win, then our losses have to be $30, $40, $50. If you can do this for 1 to 3 months, then it's ready to scale up into step number 2. Second step is now trading with 3 to 7 contracts following the same process. Now here, since we've made it to the second step, is we have to control our emotions. We need to see if we scale up and increase our size, obviously our risk will increase, but we need to see if that's going to affect our emotions. If we can trade 3 to 7 contracts and be consistent for a minimum of 1 month to 2 months, then we can go to the third step. But our main objective here is following the same process and managing our emotions around it. The third step is now trading 7, 10 plus contracts. And again, our objective is now to work smarter, not harder. A lot of people want $1,000 gains a day, $500 gains a day, but they're not willing to risk $200, $500. If you want to make good profits, you have to be willing to take the risk. Now in this period, we're gonna be following the same process, just increasing our position size. If we notice that increasing our size makes us trade with more emotions, then we know we are not ready to scale up even further. The point is proving consistency first. Once you can prove consistency for a small 1 to 3 month amount of time, then you could scale up following that same system and that same edge. Now in this, we're gonna be going through a period of trial and error. This is gonna help us enable trading different market conditions. And with different conditions, we're gonna be able to trade a little differently. So not only time is helping us, but also implementing solid risk management all combines in us building a solid, profitable, consistent, and repeatable trading strategy. I'm a firm believer that you're gonna learn the most from your losses, not your wins. So in these periods, risk management is #1 priority because you have to take the losing trade and take something out of it in order for you to win at some point in the future. A loss is not a loss if you learn something from it. And I look at every trade as a win. If I follow my plan, I respect my risk, and I learn something or I take something out of it. Now, this is probably the most important thing I wish I could go back to 2016 and tell myself is keeping my risk consistent and adjusting my position size depending on the trading setup. As a trader, you are approaching risk management completely wrong if you keep your position size for every single trade that you take. So let's say your average losing trade is around $1,000. Let's say you get long on the S&P 500 at 5,010. You're in with 5 contracts and your stop loss is at 5,005. So you're risking about 5 points on 5 contracts. If you are incorrect on that setup, it'll be a little over $1,000, which is about where your average losing trade is. Now, 20 minutes later, if you take the same exact setup and you get long at 5,010, but now your stop loss is at 5,000. Your stop loss would be 10 points away with the same 5 contracts. Now you'd be risking a little over $2,000, which is well above our average losing trades. The risks are not the same, even though you've taken the same exact setup. This is too much risk, and this is how traders incur larger losses and deplete their account much faster, and their P&L curve has much larger dips than it has rallies. Being able to adjust the position size relative to the risk that the market is offering will enable you to have a consistent profit and loss curve. So let's say my average loss is around $50 and I'm buying Tesla stock at $100 and my stop loss is at 90 bucks. So I'd be risking about $10 per share, trading 5 shares. If I were to lose on this trade, it's up to par with my $50 average losing trade. I'm okay with that. I've accepted it. However, let's say we take another trade at $100, but our stop loss, where our risk is at $99. So now we're only risking $1. Instead of trading 5 shares, that would equate to a $5 loss. What this enables me to do, adjusting my position size relative to the risk, was if I'm risking $1, if my average loss is $50, now I could take 50 shares and size up on this setup according to my risk being super small. Adjust the position size relative to the risk or how much money you are comfortable losing. Now, if I knew nothing about the stock market and I am going in blind, what I would tell myself is to learn how a market actually moves and the driving mechanics behind it, and learn how an auction facilitates trade. The stock market is very similar to the real estate market or even like a car auction, right? If you want to do something, go watch a Barrett-Jackson car auction and watch a car go up for auction and watch how many people bid for that car and watch how many people do not bid for that car. So let's say the car was in high demand, and as soon as the car goes up for auction, it starts auctioning and bidding for $100,000. And as soon as it goes up, 50 people stand up and bid for that car at $100,000, $105,000, $110,000. They are finding that to be a fair price to pay, and they are not willing to go higher than that. Now the car goes to $200,000, right? Prices really skyrocket. Now maybe you had 50 people stand up at $100,000, but you now only have one person stand up at $200,000. Now prices have become a little unfair. And if I'm a seller of that car, I'd want to sell when prices are unfair, where there's only one buyer, because that's how I will sell at the highest price possible. Now, if I'm a consumer and I'm a buyer, and if I really don't need that car, but I want it, buying it at $200,000 where nobody else is willing to pay for it makes me think that it's not really a good price for me to buy it at. In the stock market, it's the same exact thing. The stock market, or any market in itself, moves up until the last buyer buys. If nobody is willing to buy, then the market has to move down. And then the market moves down until the last seller sells. When nobody is left to sell, there's only one option for the market to go, and that's up. This information alone provides a solid foundation to any trading strategy. And think about this, the only thing us as traders have control over really is our risk, right? Once we find opportunity, we have to accept the risk around that opportunity. There's nothing worse than finding an opportunity and seeing it move without you and not being in that setup because you were scared to accept the risk and you were fearful of the uncertainty aspect of trading. Missing a trade that I planned out for is worse of a feeling than taking the setup and losing on it. I'd rather lose on the setup than not take the setup and see it go without me. The greatest risk is having no risk. I'd rather deal with oh well than what if. Oh well, I just took a losing trade. It didn't work out on me. Rather than what if I took that? I could have just made $1,000. Accept the risk. The greatest risk is having no risk, and accept the uncertainty. It takes a minimum of 10 years to become a doctor, 7 years to become a lawyer, 2 years to be a pilot. What makes you think in 3 days you're gonna become a successful trader? A lot of you have to stop rushing the process and fall in love with learning and fall in love with becoming a better disciplined person on a daily basis. Fall in love with playing the game. I don't know why many traders expect to get rich quick. One trade will not change your life. What will change your life is 1,000 repeatable, consistent trades. The quicker you come into the market is the quicker that you're gonna leave that, and always remember that. This is a very important concept here, that my job as a trader is to locate opportunity. My job is to not create opportunity. And what I see a lot of traders do is they create these false opportunities. When I first started out trading, looking back on it now, I would create these false pictures in my head of the appearance of where I thought the market was gonna go. I saw it moving up, I took it long. I saw it moving down, I took it short, and I was essentially trying to create an opportunity out of a false appearance of where I thought the market should be or where I thought it should go. So I was creating opportunities. Now in the market, my job now and how I found success is switching the mindset and locating opportunities. I wake up every single day and I go behind the screens looking for the same exact setups on a daily basis. If you look at all my trades, majority of my entries, majority of my exits are all the same because I'm not creating opportunity, I'm locating the opportunity. I'm finding the setups that I know work out for me the best, and when I find them, I'm acting upon that opportunity and I am putting risk on. I'm locating what I know and what I see had worked for me in the past because I know in the present moment that has the highest odds of moving in my favor and me taking profits out of the market. So my job is to locate opportunity. My job is to not create the opportunity. I'm a firm believer in less noise and more focus. When I first started out, and I would go back and tell myself this, to just unfollow everybody that I know on social media besides a handful of people. I used to follow 50, 100 people and try to learn every single strategy that every single guy taught online. And that was just noise because I would try to copy and paste and learn from him, but he said this and she said that, and it would just be a loop of confusion in my head. Now I could count probably on one hand the amount of traders that I follow or know on social media that provide brokerage statements and back up exactly in everything that they teach. So my advice would be to unfollow everybody that does not back up their trading, unfollow people who don't post brokerage statements, and start listening to and following other traders who can back up their word with actual evidence and actual proof, because this will help you shorten the learning curve and learn from somebody who is actually making money by placing their own trades. It's like feeding your brain with poison versus feeding your brain with seeds that's just gonna cause you to grow as a person and cause you to grow as a trader. It'll help you cut out all the distractions and focus on what's truly necessary to become a better trader. I'm very confident if you implement on a minimum one of these concepts, you will see a major improvement in your trading. If you got any value out of this, I would appreciate a thumbs up, subscribe to my channel, and comment if you have any questions. Peace out.